So today, Alphabet announced a new computer chip that is so highly efficient, it actually made a completely different company, Micron, surge over 4% in a single afternoon.
Yeah, which is just wild to watch in real time.
Right. But, while silicon is basically printing money over on the Nasdaq right now, a sudden 20% spike in global oil prices is dragging the rest of Wall Street, violently back to Earth.
Exactly. It's a real tug of war out there today.
It really is. Well, welcome to today's deep dive. It is Monday, July 2026. We are unpacking a stack of daily market briefings to synthesize what has been a heavily mixed and honestly structurally fascinating day across the global
Yep.
markets.
Yeah, it's a day defined by a massive divergence.
Yeah.
We are looking at a market torn between two completely distinct realities right now.
Oh, absolutely.
You have the sheer velocity of AI innovation pulling one side of the market upward, and then the heavy gravity of macroeconomic and geopolitical reality dragging the other side down.
Yeah, let's ground you in the baseline numbers before we get into the mechanics of why this is happening. Here is how that divergence actually printed at the closing bell.
The numbers are pretty stark.
They are. The Nasdaq rose 0.57%, completely carried by the tech sector. Meanwhile, the Dow fell 0.30%, which was really weighed down by heavy industrials.
Right. And the S&P.
The S&P 500 edged down just slightly, basically flatlining as institutional investors, brace for the upcoming earnings season and try to price in some major international conflicts.
And that split between the Nasdaq and the Dow, that is the whole story today.
It really paints a picture, doesn't it?
It tells you exactly how capital is flowing toward perceived safety and innovation while fleeing from the vulnerability of physical supply chains.
Okay, let's start with the innovation side, because the market's optimism right now seems exclusively tethered to silicon. Alphabet was the absolute heavyweight of the day.
Oh, without a doubt.
The stock jumped 3% on reports of a brand new proprietary AI chip they're calling Frozen V2. Now, the briefing notes this chip is specifically engineered to run Google's Gemini models much more efficiently.
And that single product announcement triggered a massive rally across the entire semiconductor sector.
Yeah.
It wasn't an isolated event at all.
Right. It was like a rising tide for a very specific subset of semiconductor infrastructure. Micron surged 4.3% if we look closely at today's top movers list.
Yeah, fueled by analyst optimism and expected increases in memory chip pricing.
And Nvidia added 1.5%, plus Avago rallied on the news as well. Okay, let's unpack this. Are we essentially looking at a scenario where Alphabet just built a vastly more fuel-efficient engine with this Frozen V2 chip?
Well,
And because of that, it suddenly makes all the companies supplying the oil like, Micron and Nvidia exponentially more valuable.
I actually have to stop you there because the logic of that analogy is it's actually a bit backward.
Oh, wait, really?
Yeah, what's fascinating here is that if an engine becomes radically more fuel efficient, it uses less oil.
Oh, I see what you mean.
The oil suppliers would panic, not rally. What Alphabet has actually done here isn't just building a more efficient engine. It's more like they just designed a massive high-speed superhighway.
Okay, a superhighway. Go on.
It is highly efficient for the traffic, which in this case means the billions of AI data queries running through Gemini. But because this highway can handle so much more volume so much faster, you suddenly need exponentially more asphalt just to build and maintain it.
Ah, okay. And Micron is supplying the high bandwidth memory asphalt.
Precisely. We are moving past the initial novelty phase of artificial intelligence and into the structural efficiency phase.
So the efficiency unlocks scale, and the scale requires more raw materials.
Exactly. For the last couple of years, the market rewarded anyone who could simply train a massive language model. But inference, the actual day-to-day running of these models requires a staggering amount of compute and electricity.
Right. I've read thermal bottlenecking in data centers is just a massive issue right now.
It's huge. So when Alphabet announces a proprietary chip that reduces the thermal load and energy cost per query, they are fundamentally altering the unit economics of AI.
They lower their operating costs, meaning they can deploy Gemini to millions more users without burning through cash at the same rate.
Yeah, and that signals to the market that the ceiling for AI capabilities is still rising. An AI chip like Frozen V2 doesn't operate in a vacuum.
Right. It needs the rest of the ecosystem.
It requires massive amounts of high bandwidth memory to function to its full potential, which explains the surge in Micron. Expected price increases for memory chips tell us that data center demand is still wildly outstripping supply.
And companies like Nvidia and Avago represent the broader networking and infrastructure required to link all these systems together.
Exactly. Alphabet's breakthrough proves the foundational hardware builders are going to be selling a lot more picks and shovels.
Okay, so if you just look at the Nasdaq today, you'd think the tech sector is invincible. But looking deeper into the briefings, that's clearly not the whole story, is it?
Not at all.
Not every tech giant is floating. Some of these companies are experiencing severe valuation vertigo.
It's the inevitable consequence of a momentum market. The higher a stock climbs on future promises, the more sensitive it becomes to current realities.
Take Intel, for example. The briefing notes that Intel's stock surged a staggering 278% in the first half of 2026.
Which is an incredible run.
It is, but since June, it has plummeted 28%. And the reports are clear. This drop isn't because of a catastrophic product failure or a factory shutting down. It is purely driven by valuation concerns.
Which is just a polite way of saying multiple compression.
Right.
When a stock surges 278% in 6 months, its forward price-to-earnings ratio expands massively. The stock price sprints so far ahead of the company's actual current ability to generate free cash flow.
So expectations become priced for absolute perfection.
Exactly. When institutional investors look at their spreadsheets and realize that even if Intel executes their roadmap flawlessly, it will take them 5 years of profit growth just to justify today's stock price, they start selling. The stock re-rates downward.
I want to push back on that logic when we look at Apple, though. Apple dropped 2.4% today, landing on the top losers list, despite actually having a highly positive AI rollout in China.
Yeah, that one caught a lot of people off guard.
If AI is the ultimate market catalyst and Apple successfully executes a major rollout in one of the most critical consumer markets on Earth, why are they seeing red? Is the market literally punishing them for success?
It certainly looks like a punishment, but you have to look at the timeline of the institutional trades.
Okay.
Apple had already gained 5% the previous week leading up to this news. In algorithmic and institutional trading, this is a classic liquidity event.
Meaning what exactly?
Buy the rumor, sell the news. Hedge funds and large institutions bought Apple stock last week in anticipation of a successful China rollout. They pushed the price up 5%.
Oh, I see.
Yeah, so today, when the news officially broke and retail investors started rushing in to buy based on the positive headlines, those institutions used that surge in buying volume as exit liquidity.
Wow.
They sold their massive positions into the retail demand to lock in their 5% profit.
So the good news just provided the necessary volume for the big players to cash out without crashing the bid price.
Exactly. The underlying tech is great, the rollout was successful, but the trading mechanics dictate the daily price action. It shows you how aggressively the market is managing risk right now.
And speaking of managing risk, Tesla dropped 2.05% today, heading into a highly anticipated earnings report this Wednesday.
Yeah, the tension there is palpable.
The briefing emphasizes that the bar is set extremely high for Tesla after strong recent performance. It seems like when expectations are dialed up to that level, investors get incredibly jittery.
Because you aren't just graded on your actual revenue. You are graded against Wall Street's forward guidance models.
Right.
If the whisper numbers expect record deliveries and expanding margins, simply posting a good quarter isn't enough. You have to beat the aggressive estimates and raise future guidance. If you miss by a fraction of a percent, the multiple compresses violently.
Here's where it gets really interesting, though. While the tech sector is battling with its own high expectations, we have to pivot to the heavy physical realities pulling down the Dow.
Yeah, the macro side of things today is heavy.
While Alphabet is optimizing the unit economics of a digital query, the broader market is dealing with the soaring input costs of the physical world.
This is where macroeconomic gravity takes over. Industrial stocks, manufacturing, logistics, they are tethered to commodity prices and global trade friction in a way software companies simply aren't.
The geopolitical dominoes in today's briefings are massive. First, oil prices have spiked 20% this month alone, driven by escalating conflict between the U.S. and Iran.
That's a massive move for crude.
It is. Second, the Trump administration is imposing 50% tariffs on certain Canadian goods, citing trade discrimination. And third, in the UK, the new Prime Minister, Andy Burnham, has sparked major jitters in the bond markets due to his left-leaning policy platform.
If we connect this to the bigger picture, this is exactly why an industrial bellwether like Caterpillar ended up as one of today's top losers, dropping 1.2%.
Now, before we dive into that, looking at the escalating conflict between the US and Iran, or the new 50% tariffs, or the UK's new prime minister, it's crucial for us to state that we are looking at this purely through the lens of market mechanics.
Absolutely. We're not taking sides or endorsing any political viewpoints here.
Right. Wall Street is entirely agnostic to the politics. It doesn't validate foreign policy or trade wars. It simply runs the math on supply chain elasticity, risk premiums, and raw input costs.
Exactly. A market pricing model doesn't care about the political reasoning behind a tariff. It only cares about who is going to pay it.
So let's trace that math. Oil spikes 20% due to the tensions with Iran. How does that directly hit the margins of a company like Caterpillar?
Think about Caterpillar's operational footprint. They manufacture massive physical machinery.
Right. They aren't writing code.
Exactly. To build a mining excavator, you require raw steel and aluminum, which require massive amounts of energy to mine and refine. You have to power the manufacturing plants.
Okay, that makes sense.
Then you have to physically transport 70-ton machines across oceans and continents to reach your customers. A 20% spike in global crude doesn't just increase their shipping costs. It bleeds into the cost of every single raw material they procure.
Wow, so it instantly compresses their profit margins unless they can successfully pass that cost onto the buyer?
Precisely. And just as they're dealing with that margin compression from energy costs, you add a 50% tariff on certain Canadian goods.
Which is huge for anyone doing cross-border business.
Tariffs act as pure friction in the global economy. Modern industrial companies rely on incredibly complex, highly integrated cross-border supply chains. A part might cross the US-Canada border 3 times before it's a finished product.
Oh man, so a 50% tariff is a massive, unexpected tax on that entire process.
It is. Companies are forced into a terrible choice. Absorb the cost and destroy your quarterly earnings, or raise prices by 50% and risk killing consumer demand entirely.
And what is happening with the UK bond market? Why does Wall Street care so deeply about Prime Minister Andy Burnham's policy platform today?
Because sovereign debt yields are the baseline for the global cost of capital.
Oh, okay. Explain that a bit more.
When a new political leader comes in with a platform that the market perceives might involve significant deficit spending, nationalization of industries, or heavy wealth taxes, bond investors demand a higher term premium.
So they want more reward for the risk.
Exactly. They demand higher interest rates to compensate for the perceived risk of inflation or aggressive fiscal policy.
So if investors start dumping UK bonds, the yields spike.
And that ripples across the Atlantic. If the risk-free rate in a major economy like the UK goes up, it puts upward pressure on global debt markets. It makes borrowing money more expensive for corporations everywhere.
So if you are an industrial firm, you are suddenly facing a 20% spike in energy inputs, heavy new taxes on your cross-border supply chain, and a rising cost of capital if you need to borrow money to weather the storm.
Yeah.
No wonder the Dow was deeply in the red today.
It is a perfect storm of macroeconomic drag.
So what does this all mean? I mean, while the blue chips are fighting micro headwinds, the briefings also highlight some extreme volatility in the micro-cap and unconventional spaces.
Oh, for sure.
There is a completely different game being played on the fringes of the market today, proving just how unpredictable the daily catalyst cycle can be.
The market always finds a way to surprise you.
How about case in point, Archer? They were the absolute top gainer of the day, surging a massive 20%.
A 20% move in a single trading session is tectonic.
It's unbelievable.
Archer operates in the electric vertical takeoff and landing space, eVTOLs. It is a highly speculative, high beta sector.
Right.
When a stock in that arena catches a tailwind, whether it's a successful regulatory flight test, a new commercial partnership, or an advancement in battery density, the valuation models get completely rewritten overnight.
It highlights how aggressive capital is hunting for the next major paradigm shift outside of traditional AI.
Exactly.
And from next-generation air mobility, our briefings pivot to a uniquely fascinating policy debate that is catching the attention of healthcare and defense analysts.
This one is really interesting.
Yeah, the U.S. government is currently planning to test military troops for testosterone replacement therapy. According to our sources, this proposal has sparked a broad national debate regarding the long-term risks and the overall necessity of the therapy.
This raises an important question, and it forces analysts to completely reevaluate their actuarial models.
Right, and again, treating this neutrally as a market catalyst rather than a medical or political debate. We aren't validating either side of the argument here. How does Wall Street digest a story like that?
Well, markets are essentially prediction engines, trying to price in human behavior and institutional spending.
Okay.
When an entity as massive as the U.S. military considers adopting a broad diagnostic and therapeutic health policy, it represents a massive potential shift in a total addressable market.
So it's about scale.
Right. Pharmaceutical companies that manufacture these therapies suddenly have to model out what a massive government procurement contract would look like.
But there's a flip side to that, right? The briefings highlight the debate over long-term risks.
Precisely. For every pharma analyst modeling out new revenue, there is an insurance underwriter or a defense healthcare analyst trying to model out the long-term liability.
Oh, wow.
If there are long-term cardiovascular risks or secondary health effects associated with broad deployment of TRT, what does that do to the VA healthcare system's budget 10 or 20 years down the line?
And how does that impact premiums?
Exactly. A single policy proposal creates a massive butterfly effect across the healthcare sector, forcing everyone to rewrite their risk models.
It is wild to think about the cognitive load on an investor trying to navigate this landscape. You wake up trying to parse the thermal efficiency metrics of Alphabet's new semiconductor architecture.
Yeah.
Then you pivot to analyzing supply chain elasticity in the face of Iranian oil shocks and Canadian tariffs, and somehow end your day trying to price the actuarial risk of military testosterone testing.
It proves that modern investing is no longer just about reading balance sheets. You have to be a geopolitics expert, a mechanical engineer, a supply chain logistician, and a biopharma analyst all before lunch.
Which brings us perfectly to our summary for you today. If we step back and look at the macro picture from July 20, 2026, the global market is currently defined by a razor-sharp dichotomy.
You have the engine of growth versus the anchor of reality.
Exactly. On the growth side, AI innovation is actively altering unit economics. Alphabet's frozen V2 chip is promising unprecedented efficiency, pulling critical infrastructure players like Micron up with it and keeping the Nasdaq squarely in the green.
But on the anchor side, you have the unforgiving mechanics of multiple compression, punishing high flyers like Intel and Apple when they meet the limits of institutional liquidity.
Right.
And more broadly, you have the physical world exerting its dominance. Surging oil prices, trade friction from new tariffs, and jittery sovereign bond markets are actively compressing margins and driving up the cost of doing business.
Which is dragging the industrial heavy Dow downward. It is a market deeply optimistic about the ceiling of our technological capability, but heavily burdened by the friction of our current geopolitical reality.
And that tension isn't going to resolve itself quietly. The silicon will continue to get faster and more efficient, but the physical world will continually throw up roadblocks that software cannot easily solve.
Which leaves me with a final provocative thought for you to mull over as you step away from the numbers today.
Let's hear it.
We just watched a single announcement about a highly efficient AI chip single-handedly lift the tech sector, while geopolitical conflict and trade friction drag the rest of the market down.
Right.
So what happens in the near future when these rapidly scaling AI models become robust enough to start accurately predicting the very geopolitical events, the oil shocks, the tariff impacts, the sovereign debt crises that are currently dragging the markets down?
Wow.
When the silicon side of the equation can anticipate and outmaneuver the physical friction of the real world before it even happens, who holds the power in the markets then?
Now that is a paradigm shift worth modeling out.
Thank you so much for joining us on today's Deep Dive. We threw a massive amount of complex data and market mechanics your way, but hopefully you're walking away with a much clearer framework for how the microchips and the macroeconomics are all connected. We appreciate you being here to synthesize it with us. Catch you on the next Deep Dive.